Hi, everyone. I'm Rick Bensignor, and this is the In the Know Trader webcast on StockCharts.com. This week, we'll continue with our educational segment on Tom DeMark's sequential model. We started that 2 weeks ago, and it's the type of thing that we're going to need to spend some time on because it's got lots of nuances. So we'll still teach you the different steps to it. And we'll also, of course, as we always do, go through some key charts across different asset classes just to bring you up to date on what I'm thinking across a really variety of markets out there. But look, before we get into things too, just a quick reminder that I will be speaking later this week on Friday at the Orlando Money Show. This is one of the two premier individual investor conferences in the country each year, the other being the Las Vegas Money Show held in the spring. I'll be giving two different presentations in Orlando. The first in the morning, it's 45 minutes. It'll be on behavioral finance, kind of give attendees an introduction to what behavioral finance is, and then we'll touch upon how it relates to the markets specifically. And then in the afternoon, I'm hosting a 3-hour masterclass on successful trading. And that's basically how you put a trade together from start to finish. We'll go through a variety of both ingredients one should do in order to decide even which securities they're going to trade, how to line them up for best entry, some of the models that I use to identify trend exhaustion, and kind of how to stay in the trade, as well as talk about how to know when it's just wrong and time to get it out. In other words, how to accept your loss and walk away from something that's just simply not working the way you intended, well before it becomes a disastrous type situation where you're really getting your rear end handed to you. So it really is about how to line up trades from start to finish. So that's a masterclass in the afternoon. Both these take place on Friday, February 8th, again at the Orlando Money Show. Registration for the event is free, and as they always are. So other than master classes, you can attend the entire conference for no cost, just signing up and attending. So go to moneyshow.com if you want to find out more about that. So that's kind of how we start things off. I want to get back to this sequential model that we've talked about for the last few weeks and both update you, well, not update, let's review kind of what we've already talked about, but then also expand upon some of what we've talked about, because this is still one of the key models that I use in part of my whole analysis process. It's very good at helping identify trend exhaustion. And I tend to come from the view that the most sophisticated traders and the best traders on the street are the ones who can identify when a trend is exhausting itself well before it's obvious to other people. So let's think of an example too of a stock that, well, here, let's even use what we're looking at on the screen and follow my pointer here. So you've got this uptrend, and then it starts to consolidate, and then it starts breaking down here under 215. And looks a little bit like a head and shoulders. So let's say you're out by, 205-ish or so. Seems to be a logical place that let's say a traditional technical analyst may say head and shoulders, it's breaking down. It looks like it's confirmed that it's going to break down. It's not just like a little head fake, but it is breaking down. You're out at 205. And then the stock, of course, plummets all the way down to under 145, and it's a terrific sale. And generally you're happy and all is good. The difference between, and this just happens to be on Apple, so it doesn't always line up this way, but the difference between using some of the classic technical models. And the way we look at the market is that often by the time you get a moving average crossover, or in this case, a head and shoulders that breaks down, or some other indicator that you use to get you out of something that you've been long, you're often 15, 20% off the high before that signal actually confirms itself. And if you think about this in terms of, if you give up 15 to 20% on average, and that is what is kind of accepted in the marketplace as what most investors minimally will lose from a peak or a trough before acting. If you lose 15 to 20% on the top before you sell, and you lose 15 to 20% on the bottom before you buy, you've taken a decent chunk of potential profits away. Right, so we take 15 on one end and 15 on the other, just minimally, right? 30% of the move you're not even going to partake in. So that leaves you 70% of available price action to capture. And it's just north of 2/3 of what you could, but there's a lot of extra money that's being left on the table because most technical models do not and are not intended to sell a high or buy or low, but kind of play the trend in general. And that's fine if you want average returns. I've never come from that average returns works if you're in the industry and you're trying to outperform the rest of the marketplace, which is something that I've done both as a money manager, but also as a strategist on Wall Street. I've never wanted to be average. I've always realized that in order to stand out, you've got to kind of be above average. You've got to come up with methodologies and ways of playing the market that separate you from everybody else. Otherwise, you're kind of going to perform average. So one of the things I like about this sequential model that Tom DeMark developed is that it gives you a better chance than most other models, if not every other model I can think of in the world of technical analysis, to actually buy and sell at extremes of the move, or darn close to the extremes, instead of playing for the middle. And it is a far more difficult task, I will tell you this. Doing what I do is much more difficult than just playing the middle. But realize that my clients are large institutions, as well as individual investors, but it's the large institutions that I think of when I strategize and conceptualize what it is I want to do in the market, because the goal there for me is to help them remove / reduce long exposure near real highs of the move and to get long near real bottoms of the move. And of course, when you think about it, that is supposedly the goal of everyone: buy low and sell high. But that's not what most people do. Most people tend to buy low and buy high and then sell low. And that's not generally a winning formula, especially if the market didn't continually go higher. So a lot of people think they're terrific investors, but they're simply saved by the fact that there's a long-term bullish bias in the market and that over time, stocks go higher. And if you have any question in your mind if stocks go higher over time, go pull up a 50 or 100-year chart of the Dow or the S&P, and I can assure you that the chart will start pretty darn close to the lower left-hand piece of your screen, and it'll be pretty darn close to the upper right-hand of the screen in current times. That doesn't mean there aren't bear markets along the way, and there certainly are, and they can last several years. But over time, stocks go higher, which is why people have a bullish bias. And the whole concept of investing and putting money to work over the long haul is that your money will grow over time. If you invest in a broadly diversified portfolio of stocks, some will do well, some will not do well, but collectively you will make money over time. And you know, that's the sales pitch of much of Wall Street firms is invest for the long haul. And that's because over time it's very clear that you can make money being in the stock market. If you need money over the shorter time frame, it's a different story, because then your timing has to be much better. Because if you got long stocks in early 2000, that was a terrible time where you lost over 50% of your money. If you were in technology, you lost about 70% of your money, and you had to wait years and years and years to get it back. But ultimately you did, because it's only a few months ago that stocks were on all-time highs. So, for long-term investors, they're not looking to generally time the market, and their exits tend to be closer towards the need as they get older in life to raise some capital and or shift away from the volatility that can exist in the stock market and go more towards the safety of bonds, right? So for long-term investors, the idea is to stay in the market, and over time you're going to make money. But for those of us who are looking at more trading, and I don't mean trading by buying Monday and selling Wednesday, but if you're more in the trading environment whereby you're not looking to hold things for 20 years, but perhaps weeks or months, because you see some things in the charts that you try to take advantage of, then you've got to have some tools that help you do that. And one of the most important things is you don't want to risk, or better said, you don't want to get into a trade and then turn that into an investment because the trade didn't work, and some stock that you paid 45 for, thinking that it was going to get to 55 or 60, is now trading 35. And your timing was poor to get in at 45. And now you go, well, I think over time it's going to get to 55 or 60, so I'll just stay with it. That's a whole different discussion, but what I will tell you just in a simple sense is you want to make sure that before you walk into an investment or trade into a security, if it's intended to be a trade or an investment. If it's a long-term investment, then you typically would be willing to hold something more against you than if it's a trade. And I will insist that any disciplined player in the market is going to know the difference before they commit capital, if it's a trade or an investment. It's two totally different ways of approaching what you're doing, depending upon which answer that is and what your intent is. Let's go back here now to looking at this sequential model. Remember, we talked about the setup phase. That's 9 consecutive price bars. We're going to go right into early October, late September, early October. You'll notice there are price bars, numbers rather above the price bars. They're in blue. Anytime that this software notices a pattern of 9 consecutive closes, that the close is above the close from 4 bars back, it's going to mark all 9 bars consecutively with that particular pattern. If any one of the closes does not close above the close from 4 bars back, the numbers drop off. You can see going into the all-time high, we happen to have this pattern. There's a sell-off in last June. They've got 9 bars in a row, 9 consecutive days. The close was less than the close from 4 bars back. That's a downward setup, looking for a potential short-term flip. You can see here in May, 9 consecutive days, closed above the close from 4 days back. We went sideways for 3 weeks after that. There's a downward count here that kind of called the bottom last March. There's even another one, bringing a little more data here. You can see getting awfully, close towards the low. So what's the 9 count? It identifies the minimum amount that a security has to move, either upward or downward, to at least say there's potentially trend, and this is just the beginning of the trend. Now, in choppy markets, the 9 counts are often the turns, and you don't go much beyond that. And you can see here, just using this piece of the bigger sequential model, there are often times that you can capture very decent times to be a buyer or seller, fading the move that's at hand. So selling 9 ups and buying 9 downs. In this case, we happen to have a 9 up on the day that makes, well, looks like one day before the all-time high. Bar 8 was the high, bar 9 came the day later. That led to what ultimately was the peak and then the breakdown. Do you know at the time that the 9 up is for sure a sale? You don't know for sure, but it's certainly for someone who's looking to trade Apple, given its prior multi-month history leading into it, I have a pretty good clue that a 9 count at least gives me a potential play in the opposite direction. Stock sells down, does 9 down here, 9 consecutive bars. Now, it's been selling off all the way since the peak, but in all this price action from the early October high all the way into this mid to late November low, it's only the last 9 bars of that move that pattern of 9 consecutive closes less than the close from 4 bars back 4 days ago in the case of a daily chart. If we were looking at a weekly chart, we've been looking at Friday closes versus Friday closes 4 weeks back. And we certainly got, a pop from about 170 to 185 as at least some indication, again, that you can often play 9 counts as short-term counter-trend moves. Now, that's the setup portion. We started talking about that a couple of weeks ago. But the way DeMark devised this model was the 9 count was only a temporary potential turn in what would be a greater move if the trend kept going in the same direction as the 9 count. In this case, Apple bounced the latter part of November. It did not bounce enough to stop thinking that there's still potentially trend. What would it have to do to bounce enough? It would have to get above the highest high of the 9 count that started this move. In this case, because there was a gap between bar 1's high and the prior day's close, is going to take the real high, or what you call the true high of the day. So it would, this 9 count, unless the market, the stock in Apple got above 205, the software would still look for a downward trend and an eventual exhaustion point to that trend. That's what the red numbers are. So let me again remind you what that is. That's the countdown portion. So the blue count is the setup phase. In a choppy market, again, sometimes 9s are all you go in either direction. And you can get typically 1 to 4 or 5 bar counter move, but then the bigger trend takes over. In this case, Apple still had more to go on the downside. And the red count here, the countdown, changes the mathematics of how it looks and compares price bars. It looks, once you do a setup down, as we did here on November 23rd, the software will also look to see if that bar not only closed beneath the close 4 bars ago, but also closed beneath the low of 2 bars ago. And that's what the rule is for the red count, is now instead of comparing closes versus closes 4 bars back, we're looking at closes versus lows 2 bars back. So in this case, bar 9 also closed less than the low of bar 7, so it got a 1 count in red. It started, the same bar started the countdown portion. Even though the next day had an up close relative to the day before, this close was beneath the low from 2 bars back. That gets bar 2. Let's go to the next day. Was this close lower than the low 2 bars back? It looks like it. Let me change off of candles, because occasionally I know that I've had a trouble with the candle chart. So let's Let's just take a look here and make sure. Yeah, the candle was wrong. So here, this close was above the close, was above the low from 2 bars back, and therefore this does not get a red count. This bar here, this close was above the low from 2 bars back. It also doesn't. So whereas the blue bars have to be 9 consecutive days, the count in red towards 13 does not need to be consecutive days. So if the close is not beneath the low from 2 bars back, it does not get a count. Let's look at this day. Was this close beneath the low? By a fraction it was. It gets bar 3. And this day, each close is beneath the low of the prior days. But you can see here, on December 11th, this close is actually above the high of bar 5's low. Therefore, it doesn't get a count. Ultimately, this model looks for 13 times that the close is less than the low from 2 bars back. When you get to that 13th count, that 13th bar, instead of thinking of this as a buy signal, what DeMark and the way Tom devised and thought about this model was it identifies a really bad time to be a seller in a down move. It's not designed to be a buy signal. It's designed to tell you when not to play the trend. Over many years of this model being in the public domain, which started in 1995, I believe, is the first book that Tom came out with describing this model and putting it into the public domain. Many people have turned this model into, well, if it's you shouldn't be selling, you should be buying. And the reality is that sometimes it's perfect at capturing the bottom, and sometimes it's not, which means, oh, it's like every other technical indicator in the sense that sometimes they work and sometimes they don't. The thing about sequential, though, and I can tell you from a guy who's been using this since the mid-1990s, is that I am not aware of any other model that is more effective at potentially calling the end of a trend at the time that trend actually ends than this model. No MACD, no RSI, no parabolic, nothing can call the end of a trend to the day as close to what this model can. Now, I will tell you, this model is not available on StockCharts. It has very limited distributionship as far as which vendors carry it. To my knowledge, it is only Bloomberg, CQG, which is what I'm running here, and I believe Thomson Reuters One system still may be grandfathered into it from years ago. But otherwise, it's basically just those two models, those two software companies. In this case, you got almost, I mean, bar 13 is the let's see, it looks like it was the low close at the time. You get a bounce, we come down, go beneath it. You do not get stopped out, but by the way, this pink line, which had a value of 141.65, is the risk level on this model, saying that if we close beneath that level, and there's rules on how you need to close beneath it, so it's not simply just closing beneath, then it says this model incorrectly anticipated the low to the move. In this case, we kind of went right there, we tested the level and came back, and you can see this is real time as of Wednesday morning, February 5th, the stock's trading just beneath 175. So it looks like we've got a real good bottom in Apple, at least for now. And it would say to me also that today being an 8 setup, as long as tomorrow closes above the close from bar 5, then you've got a potential setup count in the opposite direction. And if you put a trade on when you bought this in December, then you'd probably at least get out of half the trade tomorrow simply because of the 9 count. I'm not saying that would be the top to Apple. I'm just saying that we know this thing tends to turn somewhat on 9 counts. So that's what I wanted to at least cover today in, again, more fully describing this model. We'll continue to do it over coming weeks, but you get a sense of how this can work. I want to show you some other charts as we talk about the markets while we have just a few minutes left. But for instance, let's take a look at the gold chart. So let me, here we go. So this is a weekly gold chart. Notice the 13 on the peak here. Notice the 13, these are weekly peaks up here. Notice the 13 here. These are all coming above price action. The numbers are coming above. That means it's looking for exhaustion on the upside. Look at a 13 here coming underneath, right? The numbers are beneath. That's downside exhaustion. Here, back in the very end of 2013, downside exhaustion. So this is, one of the key models we look at that fits nicely into our concept that you're going to make the most amount of money being properly positioned for turns in the market. Again, a more difficult task at hand, but something that we think important. Let's quickly take a look at the S&P, just as far as what's going on in the market right now. And we've got a couple of indicators running here. So clearly we've broken above the downtrend line from all-time highs. Actually, I think, let's see what this defaults to. Yeah, this pink line going across is the 200-day moving average, so we're awfully close to it here. It's been flat for a couple months, so it says no bigger directional move. So to me, given that we're on a bar 7 and a bar 10 towards a 13, that would say in a few days we're going to have a 9 and 13 kind of show up very close to each other. Anywhere in and around 27.72 from the cloud chart is potential resistance too. So if we rally over the next few days in the market, it wouldn't surprise me, if we stall there and get a pullback. Do we get a massive pullback? Probably not. I've told institutional clients that if we could get sub 2,600 anytime in the month of February, I'd be a very happy buyer, because I am on record as saying that December lows were the lows to the move, both in the US and globally. So I do not think those lows will be tested. Therefore, if I can get any type pullback, I'm going to look to be a buyer. I don't see a reason that the S&P has to make new all-time highs this year. But at the same time, I am as convinced as I can be that the lows we saw in December are the lows. So that's a quick look on that. We're winding things up here today, so let me bring this back up and tell you that if you're looking to contact me, best way to get me is at rick@inthenottrader.com. We have a newsletter for individual investors, so if you're interested in that, please look at the website, inthenottrader.com, for it. And I'm signing off from Florida, and we'll be back next week.
Is your portfolio positioned to profit from continued market volatility in 2019? Join over 100 investing and trading experts, including policy guru Steve Forbes, emerging markets icon Mark Mobius, America's best income investor Bruce Johnstone, elite energy analysis Stephen Schork, and trading visionary Tom Sosnoff at The Money Show Orlando to get the best ideas for protecting and growing your investment portfolio during 250 in-depth presentations. Claim your free pass now at orlandomoneyshow.com.